Hello and welcome. My name is Cayley Haig and I'm a manager within the business advisory team at Vincent's. Thank you all for joining me today for Vincent's quarterly taxation update. I really appreciate you giving up your time to follow along with today's webinar. So with the start of the new financial year upon us, today's update will focus on some key changes in the new financial year for both individual taxpayers and small businesses, as well as highlight some key areas which are receiving particular attention from the ATO. The ATO are ramping up audit activity and are focusing on some key deductions, which I will highlight later in today's presentation. As always, this webinar is for information purposes only, and this slide just sets out Vincent's disclaimer in that regard. I'll just jump back, sorry. So my contact details have been included in this slide. So if you have any questions, please do not hesitate to send me an email or give me a phone call to discuss any topics further. So to begin, today we'll be looking at key changes for both individual taxpayers, and then we'll focus on some key areas which are receiving particular attention from the ATO, being work-related deductions and rental property deductions. We will then move on to discuss some key changes for small businesses, and we'll finish by focusing on single touch payroll. So as you may be aware, the government has announced new changes to the personal income tax plan as part of the 2020 federal budget, and these changes were passed in Parliament on the 5th of July. These changes are set to kick off immediately, and as such, for the year ending 30th of June 2019, taxpayers will be entitled to the following tax offsets. So to begin, taxpayers under $37,000 will receive an offset of $255. The offset will increase to $1,080 for taxpayers within the $48,000 to $90,000 bracket, and then will dwindle off until $126,000 where no offset will be received. It's also worth mentioning that the government has increased the top threshold for the 32.5% tax bracket from the previous limit of $87,000 up to $90,000 for the 2019 financial year, which provides further tax relief to taxpayers. So some good news for low to middle income earners there. Moving on, I thought it would also be helpful to touch briefly on the changes to the Division 293 tax that commenced from 1 July 2018. So just as a reminder, Division 293 tax is imposed at 15% of your taxable superannuation contributions where the adjusted income is over $250,000. So broadly speaking, adjusted income includes your taxable income, reportable fringe benefits, your net investment and rental loss. The Division 293 tax can also be paid either by the taxpayer personally, or an election can be made to have the super fund pay the additional tax. So looking at the changes from 1 July 2018, a Division 293 election form must be sent to the ATO and not the super fund in order to arrange for the super fund to release the funds to the ATO. And the election form can be completed via MyGov, or you can also have your tax agent prepare a form for you through their tax portal. Once an election has been received by the ATO will arrange for the funds to be released and applied against any tax debts that you have, and the tax must be paid within 21 days of the notice of assessment being issued. Now, to wrap up our section on key changes for individual taxpayers, I just thought I would touch briefly on lifestyle assets and the data matching that the ATO are doing in order to essentially find and monitor these assets. So the ATO have advised that they will be obtaining information from insurance policies for certain lifestyle assets over the value thresholds included in this table. This data will assist the ATO in improving their profiling of taxpayers and their accumulated wealth, as well as allowing the ATO to address a range of taxation issues. And these issues include asset betterment, whereby taxpayers may be accumulating assets but with insufficient income in their tax returns to pay for them. Also income tax and capital gains consequences in relation to these assets. and also GST and FBT considerations when assets may have been purchased through a business but used for personal use. So it's just important to keep in mind that the ATO's data matching is becoming more sophisticated and robust, and that careful consideration needs to be given to ensure all information is being reported correctly on your tax return. So we'll now look at some specific work-related deductions which are currently being closely reviewed by the ATO. So the ATO have been looking closely into work-related deductions in order to ensure that no dodgy claims are being made. As such, I thought I would highlight some basic conditions that must be satisfied in order to claim a deduction. Firstly, you must have actually incurred the expense. The expense must have been incurred in gaining or producing your employment income. Therefore, if you undertake volunteer activities where you receive no income, you actually can't claim deductions in relation to these activities. It must be in relation to earning your income. Furthermore, these expenses cannot be capital in nature. They cannot be used for private purposes. And you must satisfy the relevant substantiation requirements. So the ATO are making motor vehicle expenses a key focus for the 2019 tax time, as the ATO attempts to put a brake on dodgy tax claims, or car claims, sorry. So points to keep in mind are, while taxpayers are not required to keep receipts, you will need to be able to provide written records demonstrating how you worked out the kilometres travelled for work purposes. Also, the cents per kilometre rate has increased from 1 July 2019 to 68 cents per kilometre, and this was previously at a rate of 66 cents per kilometre. Travel between home and work is generally non-deductible and private in nature unless you're required to carry bulky equipment to the workplace. So this is particularly relevant for tradespeople. And also you must make sure that you aren't double dipping. So you can't claim a deduction for an expense related to your vehicle that you've been reimbursed for or received an allowance in relation to. So the ATO can contact your employer to check whether they have in fact reimbursed you for the expense in order to ensure that no deduction is given when it's not allowed. So the ATO are also currently targeting false clothing and laundry expenses. In 2018, around 6 million people claimed work-related clothing and laundry expenses, and these deductions totaled $1.5 billion, so it is a big area for the ATO. Now, ATO data analytics will flag claims that are significantly above the average in occupations that regularly claim for laundry, such as chefs and security guards. However, it will also flag claims made by people in occupations that usually don't claim, such as office workers. So key things to keep in mind is that in order to claim a deduction, you must again have spent the money, and you must be able to demonstrate that this money was spent in relation to purchasing or laundering uniforms. And while you don't need receipts for a deduction up to $150, the ATO still can ask you how this amount was determined. Deductions can be claimed for the following, such as specific clothing for chefs, or protective clothing, and as well as work uniforms. And this can be both compulsory uniforms, which are enforced by a policy in the workplace, or non-compulsory uniforms. However, these ones must have their design registered with Oz Industry. The expense, however, is not claimable if your boss has asked you to wear a specific colour or thing like that, such as a white shirt or black pants. And finally, with more and more workers using their mobile phones or home computers to perform business-related tasks, it's important to be aware of the records that the ATO require to support these claims. So many taxpayers think that they can just provide an estimate of the business usage percentage. However, this is not the case, and for any deduction over $50, the ATO actually require that you keep records for a 4-week representative period to determine the business usage of the expense. Appropriate records include diary entries and electronic records and bills, and you must also be able to provide evidence that your employer expects you to work from home or make calls from home in order to substantiate the deduction. There are several methods that may apply for apportioning the cost of your phone. I won't go through all these in detail, however, the information has been included on the slide. However, just to reiterate, the incidental use method can only be used if the total claim is no more than $50. Otherwise, a 4-week register is required for the other methods. So we'll now look into rental property deductions, as this is another key area that the ATO are targeting. So in financial year 2018, the ATO conducted over 1,500 audits of rental property deductions, and they actually applied penalties of $1.3 million for these audits. And they're expecting to conduct another 4,500 audits this year. The key areas of focus for these audits are on overclaimed interest, capital works and repairs, and holiday home expenses. And the ATO have advised that the main reason deductions are being denied is due to taxpayers having no documents to support a claim, and have advised that higher penalties will be applied if fraudulent or doctored records are submitted. So one key area where the ATO are seeing many mistakes being made is in relation to interest deductions on rental property borrowings. If a loan was only partly used to fund a purchase of a rental property, then an interest deduction can only be claimed in proportion to the funds relating to the rental property. Additionally, more and more commonly, the area that causes the most issues are when loans have been used initially 100% to fund a rental property purchase. However, over time, that loan may have had further funds drawn down, but these funds have been used for personal expenses such as renovations of the main residence, holidays, etc. So when this has occurred, you again must ensure that interest is only being claimed on the proportion of the funds that relate to the rental property. Tax Ruling 2000/2 sets out the special rules for claiming interest when a loan or line of credit has been used for mixed purposes, being for both income producing purposes and personal use. The ATO also seeing many mistakes being made in relation to capital works being claimed as repairs. So this is another key area that they're focusing on in these audits. So it's important to remember that repairs are limited to costs incurred in relation to restoring something that is broken, damaged, or deteriorating without improving the asset's function, which is a key differentiation there between a capital works. And capital works relates to improvements or renovations. I will note that initial repairs carried out are also not deductible and considered capital. And finally, holiday homes are also under scrutiny by the ATO, and these are typically considered to be private expenses unless a holiday home has generally been made available for rental purposes. Also, when a holiday home has been offered at mates rates, then you're limited to only claiming a deduction for expenses up to the income received. So you're unable to negatively gear a holiday home that's been offered at mates rates. So key reminders for rental properties. Travel expenses incurred in relation to residential rental properties are no longer deductible from 1 July 2017. However, the ATO is still seeing a lot of travel expenses go through tax returns. So they're particularly raising attention for this for both tax professionals and for taxpayers, just to be aware that these are no longer deductible. Furthermore, depreciation deductions are not allowed for second-hand assets acquired after the 9th of May 2017 for residential properties. There are some exemptions that do apply. And a holiday home, as discussed earlier, must generally be available for rent in order to claim deductions. So it cannot be advertised in a way to limit exposure, such as with unreasonable rental conditions. And the ATO are using data matching for accommodation sharing platforms to ensure that income from these sources of revenue are being recorded as well. So another way that the ATO is matching data with information from sites such as Airbnb to ensure this income is being recorded. So we will now move on to look at some of the key changes for small business taxpayers. As part of the government's plan to assist small to medium-sized businesses, the government has fast-tracked the company tax rate by bringing the reduction of 25% forward to financial year 2022. This was previously not expected to occur until financial year 2027, so that has been fast-tracked by the government. And they've also increased the turnover threshold for a base rate entity from 25 million to 50 million from the 2019 financial year. So the base rate entity concept has been around since 2018 financial year, but just as a reminder, a base rate entity is a company that has an aggregated turnover less than the threshold, being 50 million in 2019, and where 80% or less of their assessable income is base rate entity passive income. So this test is essentially preventing entities that are primarily used for investment purposes being able to access the lower tax rate. As always, there's a lot of attention on the small business entity instant asset write-off. This was another focus on the federal budget, and which also saw the increase of the instant asset write-off amount to $30,000, an extension till the 30th of June 2020 to use this concession. In addition, the government has also increased the aggregated turnover threshold in order for a business to be able to write off use that instant asset write-off. So it's increased from $10 million to $50 million from 2nd of April 2019. So this will now allow medium-sized businesses to also access this concession. Again, just as a reminder, aggregated turnover includes the annual turnover of a business and also its related entities or associates. So moving on, so just with the instant asset write-off being a key consideration for many small businesses, I've just highlighted some key points to remember when applying these rules. So the entire cost of the asset must be less than the threshold, irrespective of any trade-in amount. In working out if the value of the asset is under the threshold, the entire cost of the asset must be considered and not just the business use proportion. However, any private usage must be subtracted before writing off the asset. And if the instant asset write-off is used by a business, then all simplified depreciation rules must be applied, such as using the small business pool. So simplified depreciation rules must not be used in isolation. So we'll now move on to single touch payroll. So there's still quite a bit unknown about this new system, and therefore I'll attempt to touch on some of the key requirements and dates to be aware of in relation to single touch payroll. So employers with 20 or more employees had a registration date from 1 July 2018, and therefore, unless a referral was obtained, they should be well underway in using single touch payroll. However, small employers with employee numbers of 5 to 19 people, they required to start registering for single touch payroll from 1 July 2019. However, the ATO have provided an automatic extension to the 30th of September 2019 to allow these small employers to complete the registration process. However, you can still request a deferral through the business portal, or a registered tax or BAS agent can also apply on your behalf. And the ATO have advised that in many cases the deferral will be approved straight away. We've also got micro employees, which are 1 to 4 employees, and they have an option to report quarterly through a tax or BAS agent for a 2-year concession period, so up until 1 July 2021. However, in order to do this, the following must apply. So they must have only 1 to 4 employees at the date of application, and they must lodge the activity statements electronically through a registered tax or BAS agent. There are also some other considerations that must be met in order to have this extension apply, and these are that all amounts owing to the ATO are either not yet due or subject to a payment plan, and all lodgement obligations are either not yet due or subject to referral. So the ATO are making sure that small employers are up to date on their tax obligations prior to allowing this concession of reporting through BAS or tax agent quarterly. And finally, we have our closely held employers. So these are employers who employ maybe shareholders or directors and employ family members or even trust beneficiaries. And they have a registration date of 1 July 2020 and can report quarterly as well. So how does Single Touch Payroll work? So Single Touch Payroll sends tax and superannuation from your payroll or accounting software to the ATO as you run your payroll. As such, it's important to remember when you start reporting to review your business processes and data to ensure that all information is correct. You can run your payroll as per your normal payroll cycle, and nothing needs to change in this regard. And the STP-enabled payroll software will send the ATO a report which includes the following information, being salary and wages, pay-as-you-go withholding, and superannuation information as well. The ATO have provided a list of STP compliant providers which you can access through the website or through the link on the slide. Additionally, the ATO have ensured that there are low and no cost STP options available which can be found through the website. Lastly, I note that in a statement from the ATO Commissioner, Chris Jordan, he has advised that there will essentially be a grace period for the first year of reporting, in that no penalties for mistakes or missed or late reports will apply for the first year. And there's also an exemption will be provided to employees experiencing hardship or who may be located in areas with intermittent or no internet connection. So the ATO are being quite lenient as this process is being started. And just finally, as we're talking about payroll, I thought I'd wrap up this section with mentioning the payroll tax changes that we'll be applying from 1 July 2019. I do apologise if anyone today is from a different state or has businesses located in different states. However, today's focus will only be on the Queensland payroll tax changes. So the Payroll Tax Act has been amended and has increased the exemption threshold from 1.1 million to 1.3 million. So this is good news for many taxpayers. And from 1 July 2019, the payroll tax rate has also increased for employers with Australian taxable wages over $6.5 million. So they will now be taxed at a rate of 4.95%. The bill also amends the Payroll Tax Act rebate on wages paid for apprentices or trainees, and this has been extended for 2 years and they get a rebate there of 50%. And finally, the Payroll Tax Act is also amended to provide a 1% payroll tax rate discount for regional employers for 4 financial years up until June 2023. So if you are a regional employer, your payroll tax will either be 3.75% or 3.95%, depending on your total taxable wages. So some good news there for regional employers. So I want to thank you very much for listening along today for Vincent's quarterly tax update. I would just like to end by providing a brief overview of how our business advisory team at Vincent's can assist you with your tax and business requirements. As you can see on this slide, we have experts who can help with business essentials and growth, experts focused on private client solutions, as well as a designated superannuation strategy and advice team. We also at Vincent's offer a range of accounting services, so if you do need advice or assistance in any of these areas, please do get in contact with me and I'll be able to connect you to the relevant team. Again, thank you all for listening along today. If you have any questions, please do send me an email and I will do my best to answer any questions that you might have. Thank you very much.